we focus autos. Joining us on the show right now, B. Bharat Madan, the Group CFO at Escorts. Mr. Madan, morning. Good to have you on the show. You know, August marks the 5th consecutive month of a double-digit degrowth in your volumes. You expected a slowdown in the second quarter to be less severe versus what we saw in first quarter. After Dismal's first 2 months of performance, where do you actually see growth headed during the festive season?
Well, I think like you mentioned, I think we still are hoping the month of September will actually reverse the trend. So unlike in what you've seen in the first 5 months where we're seeing double-digit degrowth, probably September will be the first month where you'll see some reversal happening to the trend. So overall for Q2, which we earlier guided, probably the degrowth will slow down to a level of about 3 to 5% compared to 15-odd% degrowth we've seen happening so far in the first 5 months. So we're very hopeful, I think, for the season, September to November. So like, I think, again, I mentioned last time also, I think unlike auto segment where the issues are different, in tractor industry per se, the issues are not really there to that extent what you've seen happening in the auto space. So really, tractor play should be really doing well now with the rural market reviving, with monsoon happening to be in a good level, which it hasn't made up. So we expect next two crop seasons should actually do well, and we should see the growth probably coming back to the market.
Right. Would you though revise your target for the year lower, or would you wait for third quarter to actually play out and then see definitive trends? Also, what to understand is what's the run rate required to end the year even on a flat note?
Well, I think the next 3 months are very crucial. With the entire festive season, September to November months will be crucial to decide the fate of the whole year, how the industry grows. We'll rather wait for the season to be over. But we are assuming, again, if you look at the last 5 months of retail trend, retail has not really been that bad. Retail has been actually degrown only by a single digit, about 8% in our case. So it was only basically a bit of correction which happened in the channel inventory level, which really led to some double-digit degrowth. So we expect, even if you assume a flat growth happening on the retail level, and no growth happen in the flat volumes really in the next 3 months. Still, I think the balance of the year, you still have got a very low base with the degrowth started happening from last November onwards, really, on the numbers. So things can really look upward. So I think if you really look at double-digit growth happening in the last quarter in Q4, you can probably end up with a flat industry in this year.
Right. Mr. Madan, your market share saw an expansion in the first quarter, but that came at the cost of margins, according to analysts. Has that been on the back of higher share of low HP tractors, and what's the outlook on your market share?
So really, if you look at our market share movement trend, the movement really happens because we are really a strong player in the northern and central India market, which is basically a strong season which happens in the Rabi period. So Rabi season will really start from the second half of this year. And most of the gains also in our case happen really in the second half period. So if you look at the first 5 months, the market share has been more or less flattish compared to what last year was, and also because of the channel creation which happened. So we are hoping, I think, the next 6 months where the normal growth happens in our case, so we'll probably come back and we'll probably again have some sort of market share movement happening. So I think, as you mentioned, yes, there's been a major demand when the industry slows down. So normally the demand shifts to the lower HP segment, which is what we've seen happening in the last few months too, which has also impacted the margin slightly. But last quarter, the margin impact was twice because one, the industry degrew, so there's some operating leverage impact which we saw on the P&L side. And second was also the production cut which the company took to correct its own inventory. I think both these factors compounded the problem, which is what led to the margin decline. And now, since the inventory levels have been corrected both at the channel level as well as at the company level, so you won't see that sort of severe impact coming on the margin front going forward.
Right, and since you're looking to grab another 100 basis points of market share this fiscal, at the same time you're guiding for a mere 5 to 8% industry growth, how do you plan to make this happen without denting your margins?
So margin impact, like I said, so the company has taken a lot of cost initiatives. So obviously those things will start playing out towards the second half of this year, and we'll see some impact coming in. And the commodity price also have been softening up. So that's another positive which we've seen the last year was actually negative with a lot of inflation in the market, and there's normally a lag with the passing that increase into the market. So this time we won't have that sort of issues. So we are hoping if the things really revive well in the festive season, we should be able to deliver on the commitment which is there. But as such, like it's again, I said, the industry growth is concerned, so we're looking more like a flattish industry this year. So we're not looking at really growth guidance for the industry per se.
All right. Thanks much for joining in and giving us a sense as to what the outlook is on, the auto sales numbers, the kind of demand traction, as well as a view on your market share and margins. But let's get a move on.